Hey everybody, Frank Chen here with REIClub.com, the only site you'll need as a real estate investor. Today's quick video, we're going to talk about how to calculate the effective gross income, and for short, let's call it EGI, for commercial real estate investing. Now the EGI is the amount of income produced by a piece of property plus the miscellaneous income less or minus the vacancy costs and collection issues. Now, investors use the EGI to determine how much they are willing to pay for the property based on how much they expect to make in earnings. Now, the first thing we're going to address is the gross potential rent, or also known as the gross potential income. Now, this is the expected income of the property will produce when fully occupied and all rents are collected. Okay, so for example purposes, we have a 10-unit apartment complex, and the average per month is $800. The average rent per month is $800. So you take your 10 units times $800, that's $8,000 per month times 12 months. That'll give you $96,000 per year, okay? Now, if you're having a hard time following along or keeping up, if you click the Show More button in the description below, I've included these calculations there, okay? Now, the next thing we have to consider are the other income and revenue streams that your complex is producing, either from laundry facilities, vending machines, car wash centers, additional storage, personal errand services, late fees from rent, charging for parking permits, covered parking, whatever it may be, okay? Now, for example purposes, say you get $1,000 a month in additional revenue from these features, so times that by 12, and it equates to $12,000 per year in additional revenue, okay? Now, the next thing we're going to calculate is the total potential revenues, also known as the gross income. So we're going to take the $96,000, okay, from your gross potential rent plus your other revenues, which is $12,000, and that'll give you $108,000 per year. Now, this gives you your gross income, okay? Next, we're going to calculate what we have to subtract from this number. And the first thing we're going to address is vacancy. Now, the vacancy rate is the percentage of all the rental units that are vacant in relation to the total amount of units in the property. It's a very simple calculation. You just take the total vacant units divided by the total units, and it gives you your vacancy rate, okay? And the average vacancy rate is around 5 to 10%. The next thing we want to talk about is credits. Now, credits is the money or percentage of income that is estimated to be lost due to non-payment of rent, but also includes management fees, cost for maintenance, and compensation. For instance, if maintenance takes too long and you reduce rent for the next month just to make your tenant happy, okay? A lot of times we consider it as the vacancy and credit loss ratio. And just so you know, the credit average is around 5 to 10% around, but combined, the average is around 10%, which I want you to know, okay? So the vacancy and credit loss is around 10%. Now, the next thing I want to cover is the owner concessions, okay? This is very important. These are the things that owners offer as incentives to attract tenants and to maintain relations or good relations with their tenants. For instance, free rent for the first month, okay? Or tenant improvement allowance, which means if they stay with you for at least 12 months, they'll get a $500 or $1,000 allowance to improve on their current unit. Lower rents for exchange for services, parking, free parking, you can offer free internet access, whatever it may be, but these numbers or these values are very important to consider, okay? Now, after considering all these values, let's go ahead and calculate the effective gross income based on the numbers that we've established previously, okay? Now, you can take the gross income first, which is your $108,000, okay? And then you're actually going to do, remember I said before, you have a combined average of your vacancy and credit loss of 10%, okay? So you can take $108,000 times 10%, which comes out to be $10,800. You subtract that from your $108,000, and you get $97,200, okay? Now, this is your EGI. You still have to subtract your concessions. I didn't include numbers because these values do vary, but you get the idea, okay? Now, you have to understand, guys, as a real estate investor who is interested in commercial real estate, you need to be very familiar with the methods for calculating important values for income-producing properties. Now, not knowing how can actually potentially cost you thousands of dollars in potential income. So practice calculating these values using real deals, and you'll actually start to become more comfortable with the process when it's actually time for you to make that big investment. Now again, guys, this is Frank Chen with REIClub.com. If you enjoyed the video, click the like button, and also leave comments below about what you thought about the video, but most importantly, subscribe to our YouTube channel so we can keep you informed when brand new videos are posted every week. As usual, guys, thank you so much for your time. I look forward to talking to you next week. Take care, good investing, and bye-bye.